The banking system in the UK is made up of a range of different institutions. All of these work together to provide all the financial services that we use. The main types of institution are the central bank, the Bank of England. The Bank of England has taken a higher profile in recent years, now that it's been given operational independence since 1997. This has meant that the responsibility of the price stability or the control of inflation, and also the financial stability of the financial system, the Bank of England also acts as banker to the government, and all of the clearing banks have to have accounts with the Bank of England for the clearing of funds. The central bank, the Bank of England, forces every bank to have a certain amount of assets on reserve so that that 2% we discussed earlier is always available should people want to discharge their money from the banks. Because of that, there can potentially be a run on the bank, unlike the American institutional system, whereby each bank is independent to itself and takes its own risks. The UK banking system has a banker, which is the Bank of England. It instills discipline to retail banks, stating that they must hold on reserve enough assets to discharge their liabilities, should a certain proportion of them be drawn out at any one time. For example, Christmas, a run on a bank should not cause it to fail because of a seasonal holiday. You would not put your money in the bank expecting it to be secure if that was the case, would you? As a consequence of that, the Bank of England will, on reserve for those banks, hold a certain asset ratio. Retail banks. The main retail banks in the high street banks, often known as commercial banks. These include companies like NatWest, HBOS, the Abbey National and Lloyds TSB. They specialise in providing banking facilities to the general public through branches and the internet. This means taking deposits and making loans. Investment banks. These are often known also as wholesale banks or merchant banks. They do not deal with the public at a retail level, but act as brokers offering companies a range of services, including arranging loans and advice on some other sources of finance. This may include arranging for the issue of shares on the equity market. The deposit and loans that they take are known as wholesale deposits and will generally be a much larger scale than those offered by retail banks. Financial institutions themselves branch off into several different categories: foreign banks, building societies, financial houses, merchant banks, commercial banks and discount houses. Financial intermediaries include banks, insurance companies, pension funds and building societies. Banks, however, by law must retain some of their liabilities to be used as a means of payment and are therefore part of the overall money stock. Now we come to an interesting section, or more interesting depending on how you find the subject so far. How banks create money. If we assume that the banks will take a 10% reserve ratio and an initial non-banking sector private wealth of £1,000 cash, in other words, a private sector asset or a government liability on monetary issue of £1,000, we can now track the stages in the process of banks making money from that initial investment. People pay in £1,000 as banking deposits. The banks have an asset of £1,000 cash and £1,000 liability on deposit. Banks therefore can create £9,000 debt in the case of overdrafts. This is a loan of £9,000, granting customers £9,000 deposits. Therefore, the deposits of £9,000 are a liability on the bank's balance sheet. The banks now have £10,000 total deposits and a balancing £10,000 total assets. The reserve ratio is still 10%. It takes a while to understand, but basically if you think about it as a simple ratio of 10 to 1, 10% reserve ratio, that means that the banks in total will be able to have 10 times that, 10 times 10% making 100% of assets that they will be able to hold from a set amount. You then deduct the original 10%, and that will tell you how much debt they've actually accrued and therefore how much asset they've put on account to make for that debt to balance their books. If people believe that the bank is going to become insolvent and are unable to meet their liabilities, there may be a run on the bank. We discussed that a little bit earlier. Here, as the banks cannot pay all of their depositors, you try to get it while it is paying some people some amounts of payment. Since everyone is attempting this, it becomes impossible. Legal tender is considered any tender which must be accepted as means to settle debt. Near money also exists, however. This quasi-money consists of financial assets such as postal orders, held as a store of value rather than a medium of exchange. However, these near monies normally have to be converted to true money or legal tender before they can be spent. It is worthy of note that these near monies can be converted at little cost in terms of expense and very quickly. Functions of the Bank of England: control of the currency's currency, agents of the government's exchange rate policy, oversees the financial system, banker to retail banks, supporter of financial institutions, and banker to the government. We've covered each of these in turn to get to this point. I hope you now understand the functions of the Bank of England. Congratulations, you've achieved the end of the section. I hope you can join us in the next section. I hope to see you then.